$5 $300 gold, $115 silver, S&P 7,000, all at the same time. This isn't supposed to happen. When stocks go up, gold goes down. When fear rises, equities fall. That's the rule. But the rule just broke. And while the president tweets victory, and while Wall Street celebrates record highs, there's a factory in Shanghai that hasn't seen a single silver bar in 15 days. The lights are going out in the world's manufacturing capital. And nobody's talking about it. You're watching numbers go up on a screen. But the metal that powers civilization is disappearing. What happens when the price says $115, but the dealer offers you $90? What happens when the vault is empty, but the ticker keeps climbing? The bifurcation has begun, and most people won't realize it until it's too late. Welcome to Boring Currency Analysis. If you've been around long enough to remember when interest rates actually meant something, when a handshake sealed a deal, and when the evening news didn't feel like a circus, then this channel was built for you. We don't do clickbait here. We don't scream at cameras or promise you'll get rich overnight. What we do is translate the noise into intelligence. Strategic economic warnings for serious people making serious decisions. If that sounds like something you need in your corner, go ahead and subscribe. Not because we're asking for a favor, but because the information coming in the next 18 minutes could change how you protect everything you've built. And before we begin, I'm curious. Where are you watching this from today? New York? Texas? Maybe overseas? Drop your location in the comments. Let's see how global this audience really is. Now, let's get into what's actually happening. Let's start with what happened on January 28th, 2026, a date that financial historians will study for decades. Because on this single day, the fundamental rules of market behavior simply stopped working. The S&P 500, the index that tracks America's largest corporations, smashed through 7,000 points. Not a slow climb, a vertical explosion. At the exact same moment, gold hit an all-time high of $5,300 per ounce. And silver, the metal that analysts had written off as dead just months ago, broke through $115. Now, if you're a casual observer, you might think this is wonderful news. Everything's going up. Your retirement account balance looks fantastic. The president is celebrating on social media with exclamation points and capital letters. America is back. Stocks huge. Greatest economy ever. But here's what they're not telling you. This shouldn't be possible. In normal market conditions, when stocks rise, gold falls. When investors feel confident, they buy equities. When investors feel terrified, they buy precious metals. It's a seesaw. One side goes up, the other comes down. That's how the algorithms are programmed. That's how the system has worked for generations. But on January 28th, the seesaw didn't just tilt, it snapped in half. Both sides went vertical at the same time. And that tells us something far more dangerous than any market crash ever could. It tells us the denominator is dying. And let me explain what that means in simple terms. When you see the S&P 500 go from 5,000 to 7,000, your first instinct is to think the companies got better. Apple must have sold more iPhones. Microsoft must have signed bigger contracts. The economy must be booming. But that's not what's happening here. Apple is the same company today that it was last week. They didn't suddenly become 40% more valuable overnight. What changed is the measuring stick, the dollar. It now takes 7,000 of your increasingly worthless dollars to buy the same basket of stocks that used to cost 5,000. That's not profit. That's inflation adjustment. Think of it this way. If you lived in Venezuela and the stock market went up 1,000,000% in a year, would you be rich? No, you'd be starving because a loaf of bread also went up 1,000,000%. The numbers on the screen got bigger, but your purchasing power collapsed. That's what we're witnessing right now in American markets. The Venezuelanization of the world's reserve currency. And the smart money knows this. The institutional players, the people who move billions, they see it clearly. That's why gold is at $5,300. Gold is the lie detector of the financial system. If the economy was truly strong, if corporate earnings were genuinely exploding, if America was actually back, gold would be crashing. You don't buy fire insurance when your house is fireproof. You buy insurance when you smell smoke. And right now, gold at $5,300 is telling us the entire financial house is engulfed in flames. But here's where it gets even more interesting. The president has been demanding a weaker dollar for years. He wants American goods to be cheap for foreigners to buy. He wants to bring manufacturing back to the heartland. To accomplish that, you need currency devaluation. You need the dollar to fall. Well, congratulations. The market is giving him exactly what he asked for. The dollar is crashing. American exports might become competitive again. But there's a price. A terrible price that nobody's talking about in the celebration. When your currency collapses, everything you import becomes exponentially more expensive. oil, electronics, coffee, medical equipment, and yes, silver. So while Wall Street cheers the stock market rally, the working class is about to face a cost of living crisis unlike anything this generation has seen. This isn't a boom. This is a funeral for purchasing power dressed up as a party. The screens are flashing green. The algorithms are screaming growth. But underneath the celebration, the physical plumbing of the global economy is seizing up, and nowhere is that more visible than in the supply chain catastrophe unfolding right now in China. Because while Americans watch their 401k balances inflate, there's a factory district in Shenzhen that hasn't received a single silver delivery in over 2 weeks. The metal has stopped flowing, the assembly lines are going dark, and that darkness is coming here. There's a district in southern China that most Americans have never heard of. It's called Luohu, and right now, it's the canary in the coal mine for the global economy. Luohu sits inside Shenzhen, a megacity of 13 million people. But Shenzhen isn't just another Chinese city, it's the factory floor of modern civilization. If you're holding a smartphone right now, there's a 70% chance components inside it were assembled in Shenzhen. If you've ever bought solar panels, electric vehicle parts, or consumer electronics, they likely passed through this industrial hub. And at the heart of Shenzhen's manufacturing empire sits Luohu district, the precious metals nerve center of Asia. This is where gold and silver flow through the Chinese industrial machine. Refineries, wholesalers, armored transport companies. On a normal day, Luohu is chaos. Trucks lined up at loading docks, vault managers shouting orders, bullion bars moving from exchanges to factories to jewelry workshops, the heartbeat of the physical metals market. But something changed this month, something that should terrify every supply chain manager on the planet. On January 15th, a report surfaced from a local industry newswire. The headline was simple: half a month without receiving any silver. 15 days. For 15 consecutive days, the major wholesalers and manufacturers in China, his biggest industrial hub, received zero silver inventory from the Shanghai Gold Exchange. Zero. Not delayed shipments, not reduced allocations, nothing. The trucks arrived empty. The vault doors opened to reveal air. Now, you might think this is just a logistics problem, a temporary bottleneck, maybe a paperwork delay at customs. But that's not what's happening here. These companies placed their orders weeks in advance. They wired the money. They followed every protocol. They have contracts, payment confirmations, delivery schedules. And the response from Shanghai? Silence. The metal simply doesn't exist. Remember that arbitrage vacuum we've been tracking? That massive $20 to $30 premium that was supposed to pull silver into China from Western vaults? It worked. It worked too well. It drained London, it drained New York, it drained Switzerland. But even after sucking every available ounce out of the Western financial system, it still wasn't enough. The black hole of Chinese industrial demand swallowed everything, and it's still hungry. Now here's why this matters to you. Silver isn't jewelry. It's not just a shiny metal that wealthy people collect. It's an industrial necessity. You cannot build a solar panel without silver paste on the photovoltaic cells. You cannot build an electric vehicle without silver contacts in the electrical systems. You cannot build a 5G tower, a smart grid, or a military guidance system without silver. It's non-substitutable in most applications. There is no alternative that works as well. So when the factories in Shenzhen say they haven't seen silver in 2 weeks, it doesn't mean production slows down. It means production stops, completely. Assembly lines go dark, workers get sent home, contracts default. And here's where the psychology shifts. A manufacturer in Beijing doesn't care if silver costs $115 or $200 or $300. If he can't get the metal, his entire operation shuts down. He'll pay anything, any price. Because the alternative isn't just losing profit. The alternative is bankruptcy. This is why the price has become unanchored from traditional resistance levels. There is no ceiling when the only other option is going out of business. And think about the ripple effects. If China can't get silver through official exchanges, where do they go next? They go to Korea, Japan, Singapore. But those markets are already being drained by the same arbitrage forces. So now, Chinese industrial giants are doing something unprecedented. They're bypassing the exchanges entirely. They're sending representatives directly to mining operations in Mexico, Peru, Bolivia, with suitcases full of cash, or more accurately, with digital yuan accounts ready to transfer immediately. They're trying to buy the ore before it even comes out of the ground, before it gets refined, before it hits any official market. This is no longer a pricing dispute. This is a resource war. And the breakdown in Luohu is the signal that the official market structure has failed. The metal is no longer flowing through visible channels, because the visible channels are empty. The Shanghai Gold Exchange, the entity that's supposed to be the distribution hub for all of Asia, can't deliver. And if Shanghai can't deliver, that means the entire Asian supply chain is operating on fumes. So while you're watching the ticker tape parade on American financial networks, while analysts debate whether the S&P 500 can hit 7,500 by March, the real economy, the economy built on atoms instead of algorithms, is grinding to a halt. The factories are going dark, and the darkness is spreading. But here's the strangest part of this entire crisis. You'd expect the dealers, the people who sell physical metal to retail investors, to be screaming for inventory. You'd expect them to be bidding up prices, offering premiums, doing whatever it takes to secure supply, but that's not what's happening. In fact, some of them are refusing to buy at all, and that creates a paradox that makes absolutely no sense, unless you understand the hidden crisis destroying the retail market right now. Let me tell you about a phone call that happened yesterday morning. A business owner in Arizona, we'll call him Robert, has been stacking silver for 8 years. He's not a speculator. He's a dentist who converted part of his savings into physical metal back when silver was 18 per ounce. Smart move, conservative, prudent. Yesterday, he looked at the spot price, $115 per ounce. He did the math on his 1,000-ounce position, $115,000 in paper value. His cost basis was $18,000, a six-figure gain. So he picked up the phone and called 3 of the largest bullion dealers in the country. And what happened next makes no sense, unless you understand what's really breaking underneath the surface. The first dealer told him they weren't buying large bars at this time. The second dealer offered him $88 per ounce. The third dealer, the one with the best reputation, offered $92. Robert was confused. The screen says $115. Why is the bid $92? Is the price fake? Is this some kind of scam? No, the price is real. The metal is valuable, but the dealer is broke. Let me explain how this works. In a normal precious metals bull market, liquidity flows freely. Money moves in, money moves out. The gears turn smoothly. Dealers buy from the public and sell to the public and pocket the spread. A simple business model that's worked for decades. But what we're witnessing right now isn't a normal bull market. This is a hyperinflationary melt-up. And the velocity of the price movement is so extreme, so violent, that the cash flow of traditional dealers cannot keep pace. Here's the problem. For the last 3 weeks, as silver ripped from $70 to $100, dealers have been frantically buying inventory. They emptied their bank accounts. They maxed out credit lines. They stockpiled eagles, maples, bars, because they knew customers would panic buy at higher prices. And they were right. Retail demand exploded. But now, they're sitting on vaults full of metal and bank accounts that are empty. They're long inventory and short cash. When Robert walks in with his 1,000 ounces and asks for $115,000, the dealer doesn't have it. His operating account might have $30,000. He can't write a six-figure check. Even though the metal in his own vault is worth millions, he can't monetize it fast enough. Why not? Because of the COMEX margin requirements. To hedge his position, to protect himself from price swings, he would normally short the paper market. But COMEX just raised margin requirements to $51,000 per contract. He can't afford to post that kind of collateral, so he's paralyzed. He can't hedge. He can't sell his existing inventory fast enough. And he can't access credit because banks are tightening lending standards in this chaotic environment. He's trapped. So what does he do? He lowballs you. He offers Robert $92, hoping desperation or ignorance will make him accept. If Robert takes the $92, the dealer can flip it to a refiner or an industrial buyer for $108, pocket $16 per ounce, and use that cash to stay alive another week. He's not trying to cheat Robert. He's trying to survive. But here's what this creates: a bifurcated market. On your computer screen, silver is 115, but on the street, at the actual bid price you can get paid might only be $90. Meanwhile, if you want to buy silver, the ask price might be $135. The spread has blown out to $45. This is what happens when a currency dies. The friction of trading becomes so extreme that the market effectively locks up. You own the asset, but you cannot convert it to cash at fair value. You're rich on paper, but stuck in reality. And this is where human psychology becomes dangerous. When Robert sees that $92 offer, his first instinct is panic. Maybe the price is fake. Maybe it's crashing. Maybe I should sell before it goes to zero. And that's exactly what the dealer is counting on. Fear. But let me tell you what Robert should do instead. Nothing. Absolutely nothing. Because the dealer's cash flow problem is not Robert's problem. This liquidity freeze is temporary. It's the shock of a repricing event. Eventually, the industrial buyers will step in. Tesla needs silver for battery contacts. Raytheon needs silver for missile guidance systems. Solar panel manufacturers need silver paste. These companies have billions in capital. They don't call small-time dealers. They go directly to refiners, to mines, to large holders like Robert, And when they do, they won't offer $92. They'll pay $120, $130, whatever it takes. Because for them, the alternative is shutting down production. So if you're holding physical silver right now and a dealer offers you a lowball price, understand what's actually happening. The dealer is broke. The silver is not. Don't bail out his business by selling your generational wealth at a discount. But here's the part that should give you absolute conviction. Even in the middle of this liquidity chaos, even with dealers going broke and factories going dark, we just received a signal so reliable, so scientifically proven, that it's become legendary in financial markets. The ultimate contrarian indicator just flashed, and it guarantees, absolutely guarantees, that this rally has much further to run. Because yesterday morning, Jim Cramer told his followers to sell their silver, and in the history of modern finance, there has never been a more bullish sign. There's a man on television who has achieved something truly remarkable. He has become the most accurate inverse predictor of financial markets in recorded history. His name is Jim Cramer, and yesterday, at 10:45 a.m. Eastern Time, he sent out a tweet that should be framed and hung in every trading room across America. This silver move is getting ridiculous. Parabolic moves always end in tears. I'm going down to the safety deposit box to cash in the family silver. Bears win here. Sell, sell, sell. Now, if you don't follow financial media, you might not understand the significance of this moment, so let me give you the historical context. In 2008, 1 week before Bear Stearns collapsed and triggered the global financial crisis, a viewer called into Cramer's show. They asked if they should pull their money out of the bank. Cramer's response? No, no, no. Bear Stearns is fine. Do not take your money out. 5 days later, the stock went to zero. The bank vaporized. Fast forward to March 2023, Silicon Valley Bank. Cramer recommended it as a strong buy for his audience. 72 hours later, it became the second largest bank failure in American history. Then there was Meta. He told viewers to buy at 330. The stock proceeded to crash 70%, and Cramer literally cried on national television when it bottomed. This isn't cherry-picking a few bad calls. This is a pattern so consistent, so mathematically improbable, that hedge funds have built actual trading algorithms around it. They're called inverse Cramer bots. And yes, they're real. When Cramer says buy, the algorithm sells. When Cramer says sell, the algorithm buys. And those algorithms have outperformed the S&P 500 for 3 consecutive years. So when Jim Cramer looks at silver at $115 and declares it a bubble and announces he's selling his family silver, what is he actually telling us? He's telling us the top is nowhere in sight. If this were truly the peak, if we were actually in bubble territory, Cramer would be screaming, buy, buy, buy. That's what he does at tops. The fact that he's capitulating, that he's throwing in the towel, that he's mocking the rally. That means we're still in the disbelief phase. And markets don't crash during disbelief. They crash during euphoria. When taxi drivers are giving you stock tips. When your neighbors are quitting their jobs to day trade. When CNBC runs 24-hour coverage of silver millionaires. That's when you sell. But right now, the most famous voice on financial television is telling the public to get out, which means the public will sell too early, which means there's still massive capital sitting on the sidelines, capital that will panic buy higher when they realize they made a mistake. Cramer just guaranteed the fear of missing out phase is still ahead of us. He poured gasoline on a fire he was trying to extinguish. But while Cramer is standing in line at a pawn shop, trying to sell his family heirlooms for pennies on the dollar, the people who actually run the financial system are doing something very different. They're not selling. They're draining the vault. Let's look at the numbers coming out of the COMEX, the commodity exchange in New York, the place where the paper silver market is supposed to function. January is historically a quiet month for precious metals deliveries. It's called a non-delivery month in industry terms. Vault managers play solitaire, traders go on vacation. Normal January deliveries might total 3 million ounces, maybe 5 million in a busy year. This January, 9,680 contracts have been delivered. Do the math. 9,680 contracts times 5,000 ounces per contract. That's 400,000 ounces. 48 million ounces in a single month, 10 times the normal volume. And it's not slowing down. Just yesterday, on an ordinary Tuesday, another 79 delivery notices were issued. And here's the truly revealing detail. Wells Fargo, one of the largest banks in America, had to step in and take delivery of 52 of those contracts. This is their house account. The bank itself is scrambling to secure physical metal. Either their clients are demanding it, or they're desperately trying to cover internal short positions before an audit. When a systemically important bank is fighting for bars in a non-delivery month, that tells you panic has gone institutional. Now let's do the math forward. If we drained 48 million ounces in January, and the bleeding continues through February, what happens when we get to March? March is the primary delivery month. That's when the industrial giants show up. The Teslas, the solar manufacturers, the defense contractors. They'll arrive at the vault expecting to take delivery of their contracted metal. But at the current drain rate, the cupboard will be bare. There will be nothing but IOUs and excuses. We're on track to hit effective empty by February 20th. Effective empty doesn't mean 0 ounces in the vault. It means the only metal left belongs to people who refuse to sell at any price. The registered category, the metal that's actually for sale, is being vaporized. This is the end game. The bullion banks are throwing everything they have at suppressing the price, but they're losing the physical war. And the smartest investor in the precious metals space, a man who's been doing this for 50 years, sees exactly what's coming. His name is Eric Sprott, and last week, he made a move that should tell you everything you need to know about where this is headed. He purchased 100,000 shares of Hycroft Mining at $49.96 per share. Now, why would a billionaire buy a mining stock when the metal itself is already at all-time highs? Because he knows the next phase of this crisis. When the vaults run dry, when the COMEX defaults, when physical metal becomes unavailable at any price, the only way to get exposure is to own the ground it comes from. The mine becomes the vault. And if silver goes to $200 because of a force majeure event, because the exchange simply cannot deliver, the mining stocks don't just double, they go up 10 times, 20 times. This is the call option on systemic failure. Sprott is positioning for the resource nationalization phase, the phase where owning the dirt is more valuable than owning the currency. And notice where the capital is coming from. It's not just coming from cash, it's coming from digital assets. While gold hits $5,300, look at what's happening to cryptocurrency. The Bitcoin to gold ratio is collapsing. The digital gold narrative is dying in real time. Because when the power goes out, metaphorically or literally, you cannot barter with a digital token. You need atoms. The crypto whales are selling their coins to buy bars. And when they can't find bars because of the dealer freeze, they're buying miners like Hycroft. So here's where we stand. The vaults are draining at record pace. The billionaires are buying the mines. The banks are panicking to find inventory. The retail public, led by Jim Cramer, is selling too early. And the factories in China are going dark because the metal has disappeared. This is the setup for a market event that will be studied for generations. A perfect storm where price and availability completely disconnect, where the numbers on the screen become meaningless because the physical asset simply doesn't exist. The bifurcation is complete. The paper world and the physical world have split into separate realities, and only one of them is real. The dealers are broke, Cramer is selling, the vaults are empty. What comes next? We'll redefine wealth for everyone paying attention.